Another company that sells its products into the data center is CommScope, and they provide products that are a little more of a commodity, but are the networking equipment, cabling, harnesses, all kinds of products that you need physically to connect these servers and all this infrastructure together in order for it to work appropriately. CommScope is going to be the smallest cap company I'm going to cover, $3.55 billion market cap. Revenues are above that number. And their P ratio this year is 38.4, dropping at 10.5. Analysts do think it's priced a little too high, that the stock has run up too far. It's up 281%, so I can understand the feeling. They did blow out their earnings in their last earnings, which caused that big jump that happened recently. The revenue's just really growing nicely, 31.7. The one thing to be aware of, and I would caution, is that these products are more commodity based. You see that they're in the mid 30s historically. There's big demand, so they've raised their gross margins up to 40%. They have pricing power that I think is temporary. This is not like a semiconductor company that has these big margins or software that big margins. This is more of a commodity that temporarily has high demand because of the build out. But as you see the build out really slow down, I'm afraid these guys are going to go back to their previous margins and lose that pricing power. It's not like they have uh, a product that has a lot of engineering, a lot of patents involved. This is wiring, and they have good products. They just don't command the kind of prices that other technology products command. Four analysts cover CommScope, and they disagree on the value of the stock. The best price that an analyst is willing to put out there is $20 per share. That's their price target. But another analyst believes, boy, this stock is only worth $5 per share. So that disagreement is interesting. As we look at their forecast, their revenue is going to stop growing as fast after this year. It's going to grow at 9%, then 9.35%. And their earnings per share looks good, but it's not going to grow as much as it's been growing recently. When I value CommScope, I actually get to a small discount of 9% on this stock, principally because their earnings per share is going to be fantastic. They're just going to really expand their profits. But when I look at the free cash flows, they're just not big enough to really support this market cap or this company. Now, one of the realities with CommScope is they carry a lot of debt, which is unfortunate. They carry $7,390,000,000 of debt and only have $571 million of cash. And I decrement debt away from the intrinsic value that I calculate on free cash flows. And that really brings down the overall equity value that I have for CommScope because of that debt. It also raises the risk in the company, and I have to use a higher discount rate because their debt to EBITDA is around 7, well over the 3 that I like to use as a limit.